TVL is not a metric that tells you how much value that liquidity is actually bringing to the broader ecosystem. We've got to start to complete the picture here. How does TVL, what is the mechanism for how TVL actually results in protocol value capture?
Hi, everyone. Welcome to Unchained, your no-hype resource for all things crypto. I'm your host, Laura Shin.
Mantle is pioneering blockchain for banking, a revolutionary new category at the intersection of TradFi and Web3. Follow Mantle_official to learn more.
Today's guest is Lily Liu, president of the Solana Foundation. Welcome, Lily.
Hi, Laura. It's good to be back. Good to see you.
Nice to see you, especially because I know you're in Korea for Korea Blockchain Week. So thanks for taking the time for this. You recently tweeted that you thought revenue was the North Star metric, as you call it, for protocols. Explain your reasoning.
Well, I think it's got to be. Thus far, what is one of the critiques that we always get as an industry? Where's the fundamental value? How do I value these things? How do I know the price should be 10, 100, 1,000, a million, right? And it's honestly something that our industry has papered over, not really wanted to talk about for a really long time. And I think that now there's overall this bifurcation where you've got Bitcoin, the asset, and everyone else competing to be financial infrastructure. So I think now you can be just clear as an industry. There's digital gold, and what is a valuation metric for that? I don't know. How do you want to value gold? So you can apply that logical framework to digital gold, store value asset. It's a little bit one of a kind, sort of the non-sovereign store value. And I think that's something that people fundamentally understand. And there's, on that pedestal, room for one. And then on the other side, which is blockchains as financial infrastructure, I think there's also going to be a power law. But then the question is, do you value financial infrastructure, a financial infrastructure platform, a technology platform, the same way that you value store value asset? Of course you don't. Now, what we do have as precedents in different ways that we can start to think about this is, well, if you're infrastructure, then the value of that infrastructure should be derived from some version of its utilities. So the kind of question has always been, how does usage and utility actually flow through into token holder value creation, right? And let's put value creation aside for a second. Let's just talk about price creation right now. Those are two different things, value and price. And so what we've anchored on as an industry for the last 5 years, once people started to move beyond, okay, there's this thing which is digital gold, and then the everyone else category. We've been talking about TVL for a really long time. And that's fine to talk about TVL starting in DeFi summer in 2020 when this thing was so new, so interesting, and so impactful to be able to do DeFi on chain, that it was fine as a metric back in 2020 when you needed something to normalize these new phenomena that were popping up almost overnight. And we have a precedent for that as well. Back in the 90s, we would look at what? App downloads, or you would look at installs, you would look at signups, MAUs, or DAUs, and then MAUs. And you would look at
monthly active users and daily active users.
Right. And many of those metrics people still talk about all the time, but they talk about them in the context of these are important upstream metrics that ultimately are going to flow into value creation and then value capture, price creation, price capture. And that is the kind of evolution of the discourse that we have not had as an industry. And so we're still sort of stuck on this 2020 TVL comparison. But if you actually think about how TVL flows through, first of all, it's an easily gamed metric. But then if you think about how does TVL actually lead to value and price creation for holders? Well, explain that mechanism, right? So then what people typically say is, well, if you have a lot of TVL, then it means that there's trust in the system, and that is a precursor to economic activity taking place, and that transaction volume and continuing activity is going to be the precursor of fee revenue, so on and so forth, that will eventually accrue, right? So let's finish that sentence and let's finish that thought. What is the mechanism for how utility and usage of a blockchain actually flows through to value creation, price creation for holders and stakers, right? Well, the way is if you look at chain revenue, let's just talk about L1 protocols for a second before we can talk about apps as well, dApps and dApp chains, right? But generally speaking, the way that utility flows through is you've got kind of generally three sources of revenue for holders. So the first is inflation, and that is a protocol parameter that gets set with many different considerations, and it's set differently for every protocol. There's inflation. In the case of Solana, that's around 6% today, reduces every year on a set curve. Within the Ethereum world, it's around 2 to 3%, depending a number of factors in there. But category one is inflation. Category two, in our case, is a base fee, which is basically a fixed fee for any transaction that you put through the network. That's fixed. And then there's also a priority fee, which is a variable fee that people can choose to pay more or less in order to prioritize their transactions. So you've got inflation, you've got a base fee, let's call it a fixed fee, and you've got a variable fee. And the sum of those is revenue that accrues. And that those are block rewards that, the allocation of those is also, obviously an ongoing discussion, whether it accrues to validators or to stakers. But over time, that is going to be split between validators and stakers. And the pass through of that to stakers, and right now about 60% of holders are stakers. The pass through of that to stakers is how, as a token holder, you are participating in the revenue, the value creation of usage of the network. And so this is something that is not talked about very often. And I would say one of the reasons why it's not talked about very often is because it's not been a metric that any protocol has really been able to demonstrate up until more recently, for a number of reasons. One is just because it takes a while to actually drive real world adoption of this newfangled blockchain technology. And then also another reason is because a number of the number of the chains that have the most mindshare don't actually have the ability to capture this business model and this value creation pass through to holders. Because if you break that down, inflation, base fee, priority fee, the priority fee is high margin, right? It's like being in a grocery store where you want to be selling your most high margin products. And the highest margin product that you can offer in a chain setting is execution transactions. And if you take those execution transactions and distribute them across any number of sovereign execution environments, call it L2s, whatever you want to call it, then what you've done is you've taken your most profitable transactions and you've given up that value capture, right? And that you see and that's on top of the well-known critiques that we've heard over and over again about fragmenting liquidity and the impact of that on overall capital markets kind of system where liquidity is always important. So in addition to that sort of well acknowledged fact, what that also means is it reduces value capture for token holders. And so this is something that is not often talked about, right? You'll see so many charts in our industry, which is TVL rankings. But then if you take the TVL rankings and you marry that up with protocol revenue rankings, what you can see is a number of examples where someone will be like, I've got $2 billion of TVL. Yes, but your protocol revenue is $2,000.
So you're saying like this like people are just gaming that particular metric.
Right. And the reason why TVL is indicative, it's not unimportant, but the reason why it doesn't, it's not an automatic carry through to actual value creation and capture is because you can imagine a situation where, I could have $1 million of TVL. Let's call it for large numbers, $100 million of TVL. And I could literally put that into, call it a lend borrow once and touch it once a year. Now, that is important because on one hand, it is creating market depth that other market participants can trade against. And then the idea is that is providing some baseline of liquidity that others will be able to access and create transactions against, and that will generate fee revenue, right? So absolutely, that is part of it, which is why TVL is important. It's just not the end all be all metric, which everyone knows at this point. But it's also because if I touch that $100 million once, I pay fees on the way in and I pay fees on the way out. That means I pay fees twice over the course of an entire year, right? So that $100 million of liquidities, sort of fee generation could be twice a year. It could be twice a minute. And TVL is not a metric that tells you which one of those it is. And therefore, it's not a metric that tells you how much value that liquidity is actually bringing to the broader ecosystem, in this case, to the protocol.
So obviously, I understand, a lot of what you're saying, and some of that, I think makes a lot of sense. But I do think that, there would be people who would look at what you're saying and they would say, for instance, Solana people used to always promote REV, real economic value, which is measured by transaction fees out of protocol tips. But that now that it's down on Solana, it's not being talked as much. So I wondered what you would say.
No.
Somebody who's no.
Yeah, what I'm saying is pretty much REV. It is. And so look, this is not something where talk about it in the months that it's good and then think that it's, and then stop talking about it in the months that are no, this is, we have a core interest in that metric, always have. And that is, not a 2025 phenomenon. That is actually a 2018 phenomenon, 2020 phenomenon. So this has been this is not a new thing.
And when you say that, you feel like TVL can be gamed, there are also ways that revenue could be gamed. Wash trading, artificial volume, even incentive programs and grants can influence it in an artificial way. So I wondered how you would, address those criticisms.
Every metric can be gamed, especially in the world of fairly competitive trading participants on chain. So nothing is perfect. But the thing is that if you're actually paying for transaction, so to actually game TVL, it's basically free, right? Because obviously you have to have the stock of that asset, or that sort of quantity, the inventory of that asset. But then to actually put that on chain, let's say putting dollars, or in this case, let's call it minting a money market fund and putting that on chain, is things that people can actually do pretty easily first party. Whereas to actually be regularly paying fees, that is a cost. And so to put assets into a different form of inventory is much less costly for people than for people to actually be paying fees. It's a cost.
But I mean, there's also opportunity costs. So if someone feels like they could be earning more money by putting their money into a different protocol, then don't you feel that alone shows, especially TVL over time, shows a certain level of stickiness or confidence or trust in a protocol? So wouldn't you say that if you're looking at TVL over time, then that's especially, it's less gameable?
It's in the same way that people still look at app downloads, people look at users, people look at clicks, and people look at monthly actives and daily actives. Those are all still metrics that people look at in the tech world 25, 30 years on, right? Those are seed stage metrics. Those are Series A metrics. And then once you get to Series B and Series C, you've got to demonstrate something that is downstream of those metrics. And as an industry, we were a seed series in 2000. And when it comes to sort of DeFi and actual sort of real utility emerging on chain rather than just...
You said 2000. Did you mean 2020 or?
Oh, sorry, 2020. Yeah, okay. with DeFi summer. And so that was when DeFi just kind of as an industry in terms of its maturity, seed stage. And now as an industry, we're getting to Series A and into Series B, and then you've got to evolve the way you think about those things into actual value creation. And so I think as an industry, what we should be doing is finishing the sentence, which is not to say that you don't care about TVL, which is a way of talking about market depth, right? It's not to say market depth is not important. Of course it's important. In the same way that app downloads and users and clicks are important because those are all upstream metrics of eventual value creation, but we've got to start to complete the picture here. How does TVL, what is the mechanism for how TVL actually results in protocol value capture?
All right, so in a moment, we'll look at some examples, but first a quick word from the sponsors to make the show possible. Mantle leads the establishment of blockchain for banking as the next frontier. UR is the access layer that transforms Mantle Network into a purpose-built vertical platform, the blockchain for banking, that enables financial services on-chain. UR unifies and vertically aligns Mantle's focus on payments, trading, and assets. MI4, METH protocol, functions FBTC, supported by developer grants, ecosystem incentives, and the industry-leading distribution platform through the UR app, Reward Station, and Bybit launch pool. All economic activity within UR will be captured by Mantle Network to further drive value to token holders and establish its significance in blockchain for banking. Follow Mantle_official to learn more. Back to my conversation with Lily. Let's just talk about kind of like this focus on revenue. You know, since crypto is basically a newer industry, some would argue that focusing on revenue could hamper innovation. I'm sure you know the long history of startups that have succeeded by not focusing on revenue too early. Uber, Amazon are some examples. So what would be your response to those critics?
I think we already have the answer for that in Amazon, which famously said, we expect to be loss-making for a long time. We want to have no profits for a long time, but they had plenty of revenue. And also with so many of these very high growth companies that were innovating on entirely new tech and entirely new markets and entirely new business models. And I think what we proved out is primarily in a place like the United States, there's permanent capital formation that was also highly patient and willing to take a bet on innovation. And that's why you see so much innovation coming out of the United States in places that are able to price and value innovation in human capital. So I think the critique would be disproven by the success of high innovation economies with tons of venture capital, which has primarily been in the United States and then also on the other side of the world. So I don't think that is a critique.
All right. And so you've made a strong case for revenue. Are there any other metrics that you find useful or that you like to consider in addition?
Yeah, well, I think that generally, I think these blockchain ecosystems, I think there's sort of three components. You could call them stacked on top of one another. There's the network, let's call it the chain. There's the applications, and oftentimes those applications themselves have their own tokens. They're not protocols quite in the same way as a chain, as like a layer one protocol. And those applications, oftentimes they will have a token attached to them. Typically call them a governance token. But those applications, the profitable ones are typically those that are going to be taking a cut of transaction revenue. So there's application revenue. And then I think, so there's like network applications and there's the asset layer. And assets are what is now really coming to the fore right now with certainly stablecoin issuance, tokenization. I really see stablecoins as being V0 of tokenization. And so those are, I think, kind of like the three components of how these ecosystems are starting to come together. And so I think about those three things kind of being distinct. So for example, on the DeFi Llama page, for example, they're aggregating revenue at the asset layer, which is T-bills, for example, and revenue at the application layer, which is typically cut of trading revenue. And then the revenue that goes to the L1 protocols, and the business model for that, or let's call it the revenue model for that, is fundamentally different. That is a function of priority fees. You could count inflation in there as well, right? And so I think you got to disaggregate those three, and in those three different parts of an ecosystem actually make money in different ways, right? So the asset issuer will typically make money off of AUM, And so the AUM folks, they are going to be the most sympathetic to TVL because it looks a little bit like AUM, right? It's kind of like AUM of a protocol. And then the applications are typically going to look at trading volume because they get a cut of trading volume. That's how exchanges work. That's how decentralized exchanges work as well. That's their business model. And these chains are kind of like these funny new things that don't have a great corollary to something that we already see in either the financial world, assets, or in the tech world, applications. And these chains is like kind of like this. That's the new thing that I think we need to develop our shared language around. And what is the business model that a chain should have?
Okay.
So, yeah.
Well, it's been great getting your thoughts on this topic. Thanks so much for sharing them from Korea.
All right. Thanks, Laura.
Catch you all later.
Unchained is produced by Laura Shin with help from Matt Pilchard, Juan Aranovich, Margaret Curia, and Pam Majumdar. Thanks for listening.